If you opened a TFSA and simply transferred money in the hope of it growing over time, you are losing money unless you open up investing vehicles within that TFSA. The way to grow your money is by investing it, and just transferring it to a TFSA does not qualify it as an investment. You're basically just putting your money in a piggy bank. I didn't realize how much I lost over time by making this one mistake because it was just a savings account. I put my money in a piggy bank, not in an investment vehicle. And so in this video, I'll talk about my regrets and my mistake of simply transferring money into my TFSA and what I could have done differently so that it would actually invest and grow over time. A quick definition on what a TFSA is. It's short for tax-free savings account and is exactly what the name suggests. An account where upon withdrawal, your money will not get taxed. You transfer your after-tax dollars to a tax-free savings account where you earn a little bit of interest, and then when you withdraw that money, it will not be taxed. And so you avoid your money getting taxed twice. It's similar to a savings account where you are not allowed to withdraw your money right away. You have to wait at least 24 hours, but also somewhat similar to a checkings account where your money is not locked in unless you choose an investment vehicle which locks in your money. Every resident over the age of 18 with a valid SIN is allowed to open up a tax-free savings account and contribute some money into it. The yearly contribution limit for 2024 is $7,000. So let's just jump into what I did. Like I mentioned, I was a student at the University of Waterloo, and so I didn't have the option to lock in my money because I needed it to pay bills, tuition, rent, food, etc. I looked into the different options I had and came across the tax-free savings account. At the time, I was only thinking about saving, not investing, because A, I was not aware of, and B, I thought that all investment options require you to lock in your money for a long period of time, and I didn't have the option to do so at that particular time. So I would just transfer the limit for each year and would keep it there, and my money was only earning 0.1% interest. That is nothing. That is basically nothing. What I didn't know was that with majority of these accounts, like the TFSA or a pension or retirement account, there are options to open up investment vehicles within those accounts. And there are different options depending on your risk tolerance, and you can pick and choose any of the investment vehicles that you can open up inside of these saving accounts that don't take up your contribution limit. So it's important to understand what you need at that time and what your risk tolerance is. I was looking for two things. One, I wanted my interest rate to be higher than 0.1% because that's extremely low, and also something which was higher than the rate of inflation at the time. And number two is I didn't want to lock in my money for a very long period of time. So at that time, what I should have done is I should have opened up a redeemable guaranteed investment certificate within my TFSA, which at that time was offering me a return, a guaranteed return of around 4%, which was a lot higher than the 0.1% that I was earning. As an international student, I had a large amount of money in my bank account, which was not earning anything at all. And that amount would have earned quite a good sum of money with that 4% interest. I was a student for 5 years when you combine the study and co-op work terms. And for 3.5 years, my money was just earning 0.1% interest. And I was always very good with my money and with budgeting. So this was a huge mistake on my part. So if you are a newcomer to Canada or you don't know much about saving or investing and don't know where to start by opening up a tax-free savings account and get in touch with your bank. You can either open it online or you can call up your bank and ask them to open up a tax-free savings account for you and start looking into the different investment vehicles that your bank offers that you can open up within your TFSA. Then you can start assessing your needs. What is your risk tolerance? How much cash do you need on hand at all times? So you want to keep some amount in your checking, but if you're saving up for your emergency funds, for example, you can start saving them in your tax-free savings account. And when you are in the process of assessing your needs and understanding your risk tolerance, just try to budget the amount that you would need for a month, for 3 months, for 6 months, for a year, and you can open up investment accounts according to that. So there are some that you can lock in your money for 3 to 6 months. For some, you have to lock in your money for years. So just understand your needs and understand what your requirements are and then go through the different investment options that you can open up within your tax-free savings account. But please don't just transfer your money into the TFSA and not do anything about it. It's just sitting there. It's not growing. You're not investing it. You're just losing money every single day. Now, why is this important? This is important because inflation reduces the value of your money and thus your purchasing power. And to keep up with it, the price of everything else goes up, but your money is not keeping up with it. And so by not putting your money into a high yield savings account and by not earning interest on the money you are saving, you are basically reducing the value of your money. In simple terms, you will be able to buy less next year from the same amount of money that you have today. And so if you want to get into saving, if you want to get into investing and you have no idea where to start, maybe just start by opening up a TFSA. Start looking into options and understanding your needs, assessing your requirements, what your risk tolerance is, how much money you need at hand, what your budget is, and it's going to really help you build wealth over time.